So let's carry on then with some properties of options. Um, so the question is, this option that we talked about, so this call option or put option or this exotic option, when we conclude this contract, which it is, essentially is a financial contract between two parties, this contract will have some particular value. So money is going to exchange hands if one, the investment bank that designs this option for you is going to ask a price for this option. So we would like to know what's a fair value actually. So what should this option's price be? What is the value of this option and how is it going to depend on the parameters that are basically what parameters are affecting this stock option. So basically we can look at two types of parameters that affect the stock options price. Well, the first ones are the ones which are in the contract itself, so the contractual parameters. So if it's a call option or a put option, there will be this strike price. So I called that K before. So remember that was this exercise price, the price at which we were allowed at this maturity date, or if it was European, or at some point perhaps before this maturity date, if it was American, the price at which you are allowed to buy or to sell your asset. So that's going to which price this is going to matter for you for what the value of this option will be. And of course also the maturity that you have agreed upon, this capital T, is going to matter for the value, for the price of this option. And finally, the style of the option. Was it an American option? Was it a put option? Was it a call, an American call or an American put? So one which you can use whenever you like, at any point up until the maturity of this option until time t, or is the European option which you can actually only use at the maturity t itself. Well, those parameters are going to affect, of course, what type of option it is and therefore also what its value is. But apart from these contractual parameters which are written explicitly in the contract, also the characteristics of this underlying, of this asset that underlies this option, this derivative, are going to matter. So in our case, this would be the stock and the stock price essentially. So this stock price has a current price, so it's a current price called the spot price, today's price essentially. Usually call it S for stock or for share, whatever you wish. So if the stock is worth more today, well, the stock price today is higher than, of course, also the option price will have a different value. But not only today's value, but also the future evolution of that stock price is going to matter. So in particular, the way in which we expect this stock price to behave in the future. Or in other words, the stochastic process, the uncertain process that this stock price is following in the future. And typically this stochastic price evolution is described in terms of some volatility. So the volatility essentially measures the randomness essentially in the path that this stock price will follow in the future. And particularly it will measure the standard deviation. It will be a measure of the standard deviation of the future distribution, probability distribution of those stock prices at some point in the future. You might also expect that the growth rate of this stock price, if you expect this stock price to appreciate at say 4% per year, well, that might make a difference than if you expect the stock price to grow at only 2% per year, but there's going to turn out to be a little bit of a subtlety there. Dividend rates are going to matter because we know that if a stock actually pays a dividend during the lifetime of the option, well, whenever a dividend is paid, actually the stock price goes down. You want to know this before you buy the option because you can also already take into account the fact that at this dividend day that you can expect some point during the lifetime of your option, this stock is actually going to go down in price as the dividend is paid to shareholders, while you have not yet actually exercised the option, so you're not yet perhaps one of those shareholders. And the final important parameter that actually is going to matter for valuing this option is the interest rate. So if only for discounting, that would already be computing present value. That's one reason why interest rates are important. So how are those different parameters going to affect this option price? Or basically the intuition here is going to be the higher the likelihood that an option will end in the money, so the higher the likelihood that the stock value is going to be higher than the exercise price if it's a call option, then the higher the option value, right? So it's a higher probability that you will actually going to use this option and to have a higher value. Well, then you are willing to pay more for the option contract today. So for instance, if it's a call option, and the current stock price, so this is a table actually from a book by John Holt. This is a book that we use actually in our master's program for the derivatives course. So it's a famous book, a very well-known book for at least for derivatives pricing. So if this current stock price is a bit higher, then if you own a call option, then that's going to be good news for you. So this call option is going to be worth more for you. Whereas on the other hand, if it's a put option, well, a higher stock price means it's probably less likely that this option will end in the money, because then the stock will have to depreciate by a bit more during the lifetime for this stock price to end up below the exercise price, which is what you would like to have if you own a European put option. And same thing for the American style call and put options. So same way, but on the opposite way, basically the strike price. So if the strike price is higher, so this exercise price is higher, well, that's good news for you if you have a put option, because that makes it more likely that the stock price will end up below the strike price, and vice versa for the call option. Same thing for the American calls and puts. Well, different. I'm not going to into all of these categories here. Let me just say a little bit about volatility. So remember, volatility was the essentially the measure related to the standard deviation of the probability distribution, the future probability distribution of this stock price. So if the volatility is higher, then this distribution is going to be a wider distribution, and typically for these plain vanilla type of options, so these calls and puts, a wider distribution actually means there's a higher chance of having a particularly high payoff in the future. There might also be a higher chance that your option is going to end up out of the money, in which case it's worth zero. But remember, when the option will never have a value, a payoff is going to be below zero. So even so essentially the weight of those adverse movements, the higher adverse movements of your stock, don't weigh as heavily as the positive weights of the higher positive movements of your stock. So volatility for these call and put options is typically a thing which is going to improve the values. So and then the other parameters you can have some thoughts about for yourself, and some of them are actually subtler than others. So here's a graph basically which depicts these ideas for an ordinary, essentially European call option. So what this graph depicts, again, on the black line we have the stock price today perhaps. On the vertical axis, the y-axis, we have the price of the option. Well, first of all, the black line here is the payoff of the option. So you can see this is a call option with a strike price of 50. So whenever at the maturity date the stock price is below 50, this call option will end out of the money, so it will have no value. But whenever the stock price is above this strike price of 50, it will have a positive payoff. So that's the black line. And this payoff value, the value that you would get if today you would be allowed to use this option, that's called the intrinsic value of the option. But there is some additional value for a real option which exists, which will continue to exist beyond today. And why is there some additional value above this intrinsic value? Well, even if today, again, this option is out of the money, so has no intrinsic value, then there still is some chance, some probability that at some future date, perhaps this stock price will still rise above the strike price, and we'll get some. The option will end up in the money essentially, and that's going to be worth something to you. So the callout lines here are the values of stock prices that are, of stock options that still have some time to go before they reach their maturity. So this green line in particular is the value, the Black-Scholes value actually, for a 1 year call option. So again, the call option with a strike price of 50 euros, but with a maturity date which extends 1 year into the future. So 1 year from now, you have the right to buy this particular stock at the exercise price of 50 euros. So this green line is the value of that particular stock option today, this call option today. And the main point I want to make here is that this value is going to depend on the parameters. So in particular, if the stock price process has a higher volatility, so basically meaning that this stock moves with a larger amount of wiggling, if you wish, so a larger uncertainty surrounding its future developments, its future growth rates. That would be the blue dashed line. So the blue dashed line would be a similar call option, but now on a stock which has a higher volatility, so which is more uncertain in the future. Well, that value turns out to be higher, as I just already argued in this table, than the green value, the 1 year call option with the lower volatility. So the blue dashed line is above this green dashed line, representing the fact that for the same stock price today, the value of this option is actually going to be higher if the volatility of that stock is higher. Similarly, the red dotted line represents the value of a 2 year call option, a 2 year call option, I should say. So the stress should be in 2 year rather than 1 year. So if the maturity date is longer, in this case, you can see that for this particular Black-Scholes call option, the value of this call is also going to be higher. Why is that? Well, in this case, what's going to dominate is the fact that if you wait 2 years, there's still going to be an even wider distribution of potential stock prices 2 years from now than 1 year from now, under the assumptions of Black-Scholes pricing for options, that is. Meaning that actually the price of a 2 year call option, so one which has a longer maturity, is going to be higher in this case than the price of a 1 year option. So these are all examples of these the ways in which these prices, these option prices, depend on some of these parameters. So the next bit that we'll talk about is, well, what about these prices of these stocks? How are they actually moving? How do we describe those stock option processes, stochastic processes, and how are we going to use those to actually price those options?